what's your topic of today?
Well, you're putting me on the spot, dude. Let's talk macro. I want to talk big picture stuff.
Russia invading Ukraine. The effects are sanctions left and right. I think the West is trying to isolate itself from Russian, commodities. Is going to take a while, and Russian influence. I think finally Europe has woken up and figured out that what they've been doing is wrong. Slowly trying to invade other countries, slowly trying to gain territorial advantages. And at the same time, Germany has followed the wrong policy of buying Russian energy, being dependent on Russian energy, and it's put them in a bind. I think the old idea was like if we buy enough energy from them, we'll have enough influence. That's not the case. Russia still does whatever it wants to do. In terms of economics, the way I see it is that we already had like an upcycle of commodities, and then this is just dislocating the entire market. The market is trying to figure out avenues and trying to move. If we're not going to buy Russian oil, like who is? Is it going to be China, India? If China doesn't buy, other people's oil and prefers to buy Russian oil at a discount, that means that, there's going to be problems in the market essentially. And then you have all the metals that Russia and Ukraine actually supply the world. Those are being problematic. You have nickel. And there was an article, I don't know if it was Wall Street Journal or Financial Times, but where there was like a Chinese company that was short nickel, and they just blew through the margin calls. They're not going to be able to satisfy them. So the exchange closed the market for nickel for like a week.
They closed it and they unwound some previous trades that were already closed.
I don't think this is right? Like if you put in a trade and you're big enough, you're a whale, and it goes south against you, are you off the hook? Like that doesn't make sense.
There was a Matt Levine Money Stuff email, I believe from last week, in which he went into details about how one theme of the post-Great Financial Crisis world is that money is sort of a collective decision now about how much the world thinks that you should have, because we have an incredibly globalized, incredibly interconnected world, and our money now exists as credits in this big system that you have to follow a bunch of rules to participate in. And the abstraction of money has never been more real to me than in this crisis. You have serious regulatory risk depending on your geography, your behavior, who you're connected with, where you were born. It's really a funny thing, and it's hard in such a digitized world to get real asset exposure. I mean, this has always sort of been true, right? Like the title to property is enforceable by the government, who ostensibly has a monopoly on violence, right? That's like kind of what democracy is, sort of. But this has really torn a bunch of stuff up, and we're seeing a lot of kind of upper layers of the onion, the nickel trades being a good one, Russian banking exclusion from the world. I watched a YouTube from a kid who I used to watch give tours of random cities in Russia, talk about the sanctions on his bank accounts. He makes money on Patreon from making videos. He can't access his dollars. The only thing he can access is rubles from St. Petersburg. And of course, the price of you name it is going up. You can't buy a new car. You can't buy a new iPhone. So yeah, the world kind of collectively, the powers that be really do decide quite a lot about your financial future in a way that I think it has a lot of people a little bit shook, myself included.
Yeah. I just want to talk a little bit deeper on the nickel side, which is very interesting. So technically speaking, if I'm short something and then that blows up and I get margin called, technically the first one who needs like my account is the one that needs to satisfy that margin call. If I'm not able to, then the broker has to step in and satisfy that margin call. If the broker is not able to, the exchange has to do it. And this is the issue, is that I think it busted through all those layers, and London's metal exchange is like scrambling to prevent like damage. So they had to close and figure out what's going on. What's interesting is like the London Metal Exchange is actually owned, I think, by the Hong Kong. Yeah, the Hong Kong Exchange and Clearing Limited owns the London Metal Exchange. So it's interesting how all of this stuff is like intertwined.
I know that in the Victorian era, when banks were less fractionally reserved and were not necessarily backed by the full faith of the government, that it was expected that anyone with equity in the bank would actually pony up capital calls when banks really needed it. That was part of your obligation. You get the benefits of being a shareholder. You also get the liabilities of a potential capital call. That also makes me think of an older story. I think it was 2018. There's a great New York Times story. I'll try to link it in the section below, about a guy, like a rogue trader who was in some beautiful enclave in Sweden or Norway trading German natural gas, who completely wrecked the market on margin. And in the same way that you just described, first it goes to the broker, then the exchange, and up. This guy blew up a ton of layers. He was trading hundreds of millions of euros worth of natural gas futures and got on the wrong side of a trade. And he had been extremely successful up to that point, and then blew it all up in a matter of, I don't know, a couple days.
But usually the case is like these companies, what they do is they essentially, they're short futures, meaning that they already sold the product, and so what they're trying is to lock in the price. But if the futures move against them and they already sold the price at a certain price, like they're going to end up net negative, because the short goes, it loses value, or becomes more and more negative, but they have a fixed amount.
You can't produce as fast as that margin call comes in.
At the same time, yeah. I do wonder also, like airlines now, that makes me think, like, how hedged are they for the fuel?
If any airlines have overhedged on oil, which has shot up in the past week.
If you overhedge, you're actually making money, right? Because actually what you're doing is you're buying futures. The airlines are buying futures. So they're buying futures at a certain price. They want deliveries at, like, let's say $70, and then when oil went to let's say $150, but they're sitting on a $70 delivery. Now that paper is worth a lot of money. At the same time, their tickets are gonna cost way more, because if they decide to sell that paper and take the hit of $150 in oil, then jet fuel is going to be more expensive.
It's easy to forget that some of these companies have enormous exposure and sophisticated trading desks internally that deal with these questions, and that these type of strategies go all the way to the top. Do we hedge 0%? Do we hedge 50%? Do we use some sort of CTA trend trading signal? There's everything out there as far as what these companies will do to protect themselves from supply input increases. This also reminds me of The Smartest Guys in the Room. Have you ever read that book?
No.
Yeah, it's the Enron story. So Enron was functionally, I may be getting this wrong, but I recall that they were a trading desk that sort of got into the physical space, and they were trying to create new trading markets in natural gas or in like pipeline usage. But they were hardcore traders first. Right? Yeah, for a while they definitely did succeed, but they were also trading. They were trying to make markets in California electricity. That was a whole big scandal. But they were scalpers. They were traders first, directional kind of discretionary traders who then try to get into, buy a bunch of operations and play both sides of the trade, eventually failing spectacularly at that.
Yeah. The other commodity, the last commodity I'm going to talk to, is about wheat, and it really has a big influence. Wheat comes from essentially Russia and Ukraine, a large portion of it at least, and wheat is up a lot. And the last time wheat was up a lot, it drove the Arab Spring. The Arab Spring kind of like grew out of food inflation, and those countries are very much dependent on wheat.
Agreed. I have no short-term predictions about this. I'm not trying to position myself in one way or another. Risk assets are reacting as risk assets do. I will link to one more thing in the description. A friend of the show, JD, sent over a lecture from a University of Chicago professor. Did you get linked that from maybe 2014? A lecture about the the 2014 crisis and Russia overtaking Crimea. Did you see
Oh
this?
yeah, it was actually spreading around.
It went
social
super
media.
viral. Yeah, anyone who hasn't seen that, I would recommend at the very least taking that perspective. It's really a kind of a reframing of what you might see in regular channels of media.
Let's go to my topic, which is the Roth IRA. It's for 2022. So the Roth IRA is a retirement plan. In it's we can divide the important topics within the Roth IRA into three buckets. One is the post-tax contributions. The other one is the tax-free growth and the tax-free distribution. So let's talk about the first one, the contribution limits. Post-tax contributions, obviously they're after tax, so they're not tax deductible from your income. There's a $6,000 contribution limit, and you get an extra $1,000 if you're age 50 or more or older. There's also an income limit, and it depends on your filing status. So if you're single, it starts to phase out. Your ability to contribute to the Roth IRA starts to phase out at $129,000 for 2022, and it's completely phased out by 144,000. For married filing jointly, starts at 204,000, and then it's completely phased out by 214. If you're above these income limits, the solution might be a backdoor Roth IRA, and that's something we're going to talk about in the future. Very simple, tax-free growth. Any dividends or capital gains from your Roth IRA account, it's accumulated in there. You don't pay taxes on it every year. And when you're distributing the capital, it's mostly tax-free, but you just have to follow two rules. One is that you have to be over 59 and 1/2 years old when you're distributing it. I think you have to be over that by year end, right? And then the other one is that you have had to have the account open for 5 years since you first contributed to the Roth IRA. So it has been at least 5 years since you first contributed to the Roth IRA. You can take out the money from there's a couple of exceptions. One is the first time home buying. There's amount you can take out there. And the other one is for college expenses and other situations. But I would never recommend anybody taking out money from their Roth IRA to do this. It's one of the best accounts available for someone to save for retirement, and that's what it should be done. And the one big exception here is that there's no minimum distribution requirements from Roth IRAs during your lifetime. So it's an excellent avenue for estate planning or pre-estate planning, I would say. So if you have enough money for retirement from other sources, then if you have an IRA, you might want to consider converting into Roth IRAs. You're not having forced to distribute that IRA in the future. So that's the topic of today from my end.
I like it. Roth IRAs are such an awesome deal. They're talked about quite a bit because they are one of the best deals in modern tax history. I want to shout out two epic Roth IRA investors. Some people got really mad about this. Peter Thiel got up to, I believe, $5 billion in a Roth IRA by using founder shares of PayPal. He probably got Facebook in there too. He crushed his Roth IRA and everyone's really mad about it. Ditto with Ted Weschler, one of those guys, a heavyweight at Berkshire Hathaway. Also invested like an absolute beast in his Roth and got, I think, also approaching, well into the high 7 figures in a Roth. I don't know. I respect it. They played by the rules of the game. They compounded really hard. They took big risks and it worked out. So kudos to these guys, the king of the Roth.
Yeah. There is you can do specific things in a Roth IRA. You can technically put shares of private companies in there as long as your contribution is less than the limit, right? If you're founding a company, or let's say if you're investing in a minority investor, let's say in a startup, and you're putting you're buying $2,000 worth of that, you can put those shares into a Roth IRA if you satisfy the income limits and everything.